Ladies and gentlemen, welcome to the first Model of a Journey webinar. In London, we have Stefan Ott, Hamish, and in UAE, we have Dr. Robert Barnes. Now, ladies and gentlemen, Robert, Stefan, Hamish, why don't you tell our audience who you are and what you do? Robert, first of all, over to you in UAE.
Well, how do you do? This is Dr. Robert Barnes speaking. I'd like to thank Herbie and Mondo Visioni for inviting a humble practitioner to address such a distinguished audience. My background is 30 years in the capital markets. I started in 1994 at what became UBS for nearly 20 happy years, and then recently nearly a decade at London Stock Exchange Group. I had the privilege to run two successful regulated multilateral trading facilities as the founding CEO of UBS MTF from 2010 to 2013. And then from 2013, for nearly a decade, the CEO of Turquoise, where one connection enabled one to trade 20 countries worth of securities and settle into the respective countries. I'm currently the co-CEO of BPX, which is a new venture, which is seeking to bring innovations to the real estate market through tokenization. Thank you very much.
Stefan, now I've seen you before, I think, in a former life. So who you are, yes, of course, and what do you do these days?
Yeah, Stefan Ott. I also have a background in computer science, but started actually my career working at a stock exchange. Was responsible for the market data and information products, one of which you can still see on television nowadays with the DAX, the German share display board, which is still alive even after 35 years. Then I moved on to work for a news agency, Reuters, later Thomson Reuters, mainly responsible in various capacities and roles for their market data distribution products and technology around content acquisition, content contribution, and distribution. Then joined IBM for a couple of years, worked there also in the financial services sector, responsible for their products in that space until 2016, when I acquired software from IBM, which actually was built for stock exchanges, which hopefully we'll be talking about later as well, which allows for low latency messaging infrastructures to be built trading systems upon.
Thanks, Stefan. Next we turn to Hamish. Hamish.
Hello, good afternoon, Herbie, and afternoon to everyone who's listening as well. So I'm Hamish Shadurian, Head of Sales Marketing at Sinara. So I joined Sinara back in 2006, straight out of university. Well, actually, I studied computer science. It's a great background there to have computer science and physics, actually. But I've done less with the physics. I've done less with the physics. So I started as a software engineer at Sinara and spent around 10 years building many types of systems I'm sure we'll be talking about this afternoon. Market data, distribution systems, trading platforms, market surveillance, a whole range of operational systems across the trade life cycle. So built up that experience, always had an interest in the business side of things, the business side of software, and gradually moved over to that kind of more consultancy role, working more closely with clients to understand about their business requirements and how to translate that into software solutions. And then gradually moved over into sales, and now I head up our small sales team at Sinara and work closely with our clients and prospects to really build the next generation of trading platforms and new solutions.
Thanks, Hamish. Now, as I said before, technology is probably too important to leave to technologists. No offense meant, gentlemen, but that's the way it is. I myself used to be a technologist. In fact, when I moved from technology to marketing, product management, they said that I'd gone to the dark side. I'm not sure they said that to you, Hamish, but that's what they used to tell me. Now, Robert, you have been a market practitioner. You've run markets. Why is technology so important to financial markets and to the capital markets?
Well, thank you, Herbie. So really, what technology is a great enabler. Where technology can, technology will. And we think back, it's only really 30 young years ago when I started, pre-internet, where memos were typed on paper, copied, and distributed, where trades on the open outcry trading floor with the hand signals could take up to 1.5 minutes to trade. Well, with the introduction of the internet and the subsequent electronification of stock exchanges worldwide, we saw a really significant growth in the scale and size of activity. And what's really important, and I think to Herbie's opening remarks, is that the combination, the intersection of the legal contract under which we engage as trading partners, plus the ability of technology, really allows the business to grow. And I'll just give a simple example. On anonymous order books, where I might lift someone's offer or someone might hit my bid, because of the presumption of enforceability of legal contract, that confers confidence in that marketplace. It is the ability of technology then to significantly scale that activity and, through a well-designed market structure, deliver scale efficiencies to market participants and ultimately end investors. Thank you.
Okay, so as Robert said, technology has been an enabler for many of the things that we've seen in financial markets. I come from a background where, when I started, we had like paper tape, we had punch cards, which you guys probably haven't seen before. Stefan probably has, but certainly not Hamish. When I started, a very fast feed from the markets was something like 1,200 bits per second. Okay, which you can't. In fact, even paper tape was probably 50 baud or something like that. Now, you two gentlemen, Stefan and Hamish, in your businesses, you are probably having to respond to changes in regulation and what technology can do for clients. What sort of things are your clients asking you to do for them? First of all, turning to Stefan, when a client comes to you, typically, what is it that they're asking you to do for them?
Okay, so yes, the typical clients are stock exchanges around the world. Their requirement is to build a fair trading space and place. And fairness, I think, is one of the key aspects, so that all have a level playing field. And I was also one participating or joining an exchange when there was still an open outcry. So how could you possibly build a fair digitalized version of an open outcry platform? And this is what I think our customers are demanding, stock exchanges are demanding. So other than lowest latency possible to be the fastest, the first one actually will only get or hit the trade. That's then also about fairness, which comes with the confidence, as Robert mentioned, to have this as an agreed and fair marketplace, so that the level playing field.
Yeah. Well, you raised the topic there of fairness, which is something I'll come back to Robert for in a few minutes, but because fairness means different things to different people. In that one person's fairness is another person's unfairness. Turning next to Hamish, what is it typically that your clients come to you for to do?
Sure. I think you can probably categorize that in a few different areas. So one may be where, and I think we'll expand on this in the conversation, where there's some kind of an internal issue. Now, typically that's usually some kind of risk, whether it's manual risk, some kind of market risk that's been identified, regulatory risk, or any other sort of internal business risk that's been identified. And something needs to be done, typically, hopefully from our point of view, by a technology solution to address those risks, improve workflow, reduce inefficiencies, help with that scalability that Robert was talking about as well. So that we can think of that as being something more internal. So you create some kind of software solution that staff within the business, and perhaps to some extent customers as well, which is an interesting concept in and of itself, will be using to really push their business forward, improve how they do things, and fundamentally transform the business operations. Another area we can think of as being more external in a sense. The business is looking, whether it's an exchange, broker, clearinghouse, different market participants, they're looking to launch some kind of a new service to market. We've worked on similar sort of digital platforms as well. That's certainly an area of big interest. And that's where you clearly need some kind of technology to underpin that. The actual setting up of whether it's a new contract, a new exchange, a new trading platform, is in itself a huge amount of activity. And often, in a funny sort of way, the technology is only one small element of it. But of course, it's a huge amount of work. And certainly we're brought in to help with the business to actually set that up and deliver it. I suppose another area you could think of is where you actually do already have some kind of an existing system, a legacy platform, legacy IT system. That's sort of done the job for many years, seems to work. I mean, a number of conversations I've had over the years where people will say, yeah, we're actually quite happy with it. But then 2 years later, when we replace it, they'll say, oh, I can't believe we were actually using that thing at all. So the replacement of legacy systems is also another sort of big area where we do a lot of work.
But I guess sometimes the market doesn't always know what it wants. Do you find that that's a big problem? Robert, does the market always know what it wants, or is it used to, okay, this has always worked, it's worked for the last 20 years like this, why do we need to change? Is that a typical attitude within the marketplace?
Well, I think we are really privileged to work in our finance industry because it really is a community spirit trying to solve problems to make markets more efficient and ultimately deliver for the end investor. And I think why technology is so special as an enabler, it can really take advantage of a kind of a local economic environment. I'll give you a perfect example. I think many will remember in 1999, the introduction of the euro. And it was from that point, there was the ability to launch a product. And here I give credit to Deutsche Börse and Eurex for launching the Euro Stocks futures, which started with no activity and ultimately grew to become super successful, the most liquid contract in Europe. The other thing about the technology is, as I mentioned, whereas manual trades may be measured in minutes and seconds, today we are time stamping the precision of equity trades to 1 microsecond, 1/1,000,000th of a second. All of that activity is fully auditable. The ability through technology connectivity, and this is where I think colleagues like Hamish and Stefan can speak, it widens the addressable universe of investors, and it also widens the diversity of products available in order to build more robust portfolios and more efficiently transfer risk. Thank you very much.
Now Stefan and Hamish, touching on some of the points raised by Robert, markets are becoming faster and faster. Latency is the name of the game. There's more and more data because markets are becoming totally electronified, if there's such a word, which means that the data rates are getting higher and higher and higher. Stefan, your company specializes in low latency. Is it both exchanges and market participants, or
yeah, it is mainly exchanges and MTFs, so all facilitating technology exchange or trading systems. And here, yes, latency matters and speed matters. So volumes in terms of number of orders per second and the thousands of, actually millions of orders per second, that's one angle. The other part is latency. And the race to zero latency is clearly something which quite a few exchanges have this on their punchline. So I'm the fastest exchange. I have
or the fastest trading engine.
Or the fastest trading engine. So that's clearly the goal. Again, that said, when it comes to the entry point to an exchange, from that onwards, all the orders, all the messages should be treated in the same way, no matter which gateway has been used for that. So the connection between the gateways to the matching engine, that's actually something where everyone should be treated in fair and the same manner. That's what I mentioned about fairness. Not only in the lowest possible latency, but also who comes first gets the first.
And that's where the regulator has a very strong interest to make sure that the market is fair and so on. I guess, Hamish, that you're are you on the opposite side of that in terms of your aiming on the broker side in terms of systems to handle this? It's data.
Yeah, I mean,
is that fair to say? Or?
Yeah, it's interesting in a way because we've worked both on the exchange side on many of these systems and on the sort of broker or the member side. And it's always fascinating to see sort of the requirements and the points of view of people on sort of both sides of that equation. Just touch briefly on the low latency bit. I mean, in terms of the technology to build software to handle higher throughput, higher volumes of data, and absolutely, I mean, volumes have just been going up and up and up over the years. And we've done a huge amount of work in terms of both our market data platforms, trading platforms, our own matching engine, to look at being able to ensure that we can have as low latency as possible. But I think what I would say is not every application necessarily needs low latency. And in any project, you should at least identify what your latency requirements are, which sometimes doesn't happen. It's not necessarily an automatic assumption that a particular system has to be low latency, given the amount of effort, not necessarily just in building the software to handle that, but in maintaining, fine-tuning, optimizing systems on an ongoing basis to meet those sorts of low latency requirements. So having that early identified an early point is quite
well, I guess another point here is that, and Robert, this is where you're coming as well. I know that one of the things that you do some work, I think you're related to the National Physics Laboratory in terms of clocks, like a clock and data. Are you involved in that sort of thing, where you have to have a clock signal that the whole market uses to ensure that timings are universal in terms of universal time?
Well, certainly it's my privilege to be a humble participant on the National Timing Center Program Steering Committee, which is led by the National Physical Laboratory. And I think many on this webinar may know, but people are often surprised to learn that in 2020, the IOSCO, the International Organization of Securities Commissions worldwide, agreed that the timestamp for all financial reporting worldwide would be UTC, which is otherwise, GMT, that people know, Greenwich Mean Time. But what's important about time is the fact that it allows us to sequence events, and it therefore gives us the ability to have time priority in order books in order to maintain a level playing field. And it also means that in the event with technology, as much as people invest for resilience, we always need to anticipate somewhere up and down the value chain, whether it's at a member or a market operator, there may be a technical glitch, and therefore one needs to be able to communicate the last good time stamp at which orders that were sent received acknowledgements and you knew they were good. Afterwards, where it's uncertain, you can purge the orders and then allow the members to reconnect. So time is absolutely pervasive everywhere. But where I think time is very interesting is if you take a look at 2010, when the US markets had their flash crash, and as a consequence, there was a very well done report, The Future of Computer Trading and Financial Markets, led by Sir John Beddington and the Government Science Office, where many of us were actually very privileged to participate, and you were involved in that as well. I think what it came out as a conclusion is that actually high speed, high frequency, high speed trading can be done safely and give benefits to investors. And I think Stefan and Hamish would probably agree, while not everybody is a high frequency trader, those that are doing high volume market making are able to more comprehensively look at and manage their risk, and as a result contribute liquidity that has narrowed bid offer spreads, it has narrowed implicit costs, ultimately benefiting institutional and retail investors. But we've also had then innovations to do electronic block trading and other execution channels to help investors get their business done. What I would finish on is to say that because time helps us sequence events in databases, actually those events can be linked to the legal contracts that confer confidence. And one can see the future of where contracts can be further authorized, authenticated with precise timestamps to help people do more business with more confidence. Thank you very much.
Well, as I said, I've been around for a long time, as you can probably tell from my white hair. But I remember in the early days of where Stefan and I used to work before, on the operational systems, the operators would actually enter the time by looking at their watches. No, it's a far cry from that now. It's all automated. Low latency, it's all very sexy and all that sort of stuff, but there are more mundane activities that makes the difference between making a profit or not. Workflow is very important. Hamish, I guess that lots of your clients come to you looking at workflow. How can it be improved? How can it be automated?
Sure.
How does that work?
At the end of the day, it's people's jobs, it's people's day-to-day professional roles, and a lot of the systems we build, we're conscious that people will be using them on a day-to-day basis, possibly for many years. They want to build something that really helps them do their role better and obviously meet the strategic objectives of the business. And that's probably why we've been brought in to build something new. I mean, if you take the average example, you'll go into, let's take a broker as an example. You'll go in, there'll be a workflow for a certain process. Yes, there may be some manual elements. There may be one or two disparate systems which are used in different ways. There'll probably be, the fabled Excel spreadsheet that actually runs the entire business, and a few people know how to use it, or dare I say, sometimes even just one person knows how to use it. And you have to be pragmatic. Sometimes you won't be able to necessarily immediately replace all those things immediately. But what you do want to do, and that's certainly what we seek to do when we go in, is to create a new solution that will at least provide a pathway towards really transforming the way people do things. Provide those immediate quick wins, or handling some of those immediate risks that the business is facing, but also create something new that, at the end of the day, this is going to be in place for years to come. It's going to need enhancements. The business needs will change. And you want to create something that will not only be used today with the immediate needs and risks and so on, but can really be adapted towards the future as well. And you want to do that in a way that obviously takes everybody with you. So we as a technology vendor can help with that. Clearly, customers themselves often have to go on a journey themselves as well in terms of that transformation. It's always, certainly from our point of view, it's really interesting working closely with them as they go on that journey. It's not just about new software technology, but also new ways of working as well.
Absolutely.
And it's always great to
So
see
it's
that
it's like a hybrid of the people and the technology, making sure that they all mesh together in a seamless way. Yes.
You summed it up perfectly.
Yeah. Because systems are not just computer systems; it's also people.
It is.
How
It's people who use
technology interact.
Yeah, indeed, it's people who use them at the end of the day.
Exactly.
And ultimately, all technology has to be a tool and needs to serve people in their roles and ultimately the customers that they're working for.
Which I think is the angle which needs to be added to the absolute lowest latency and the possibility to get things done in microseconds. In actual fact, to add to Robert's point, it's not only about microseconds. We are talking about nanoseconds now, and I already see requirements to go into picoseconds, just in terms of timestamping.
Exactly.
So that's what people are demanding. Other than that, I think it's about not the absolute latency, but it's about the predictability. So how can you make sure that this is a reliable figure, an average latency rather than an absolute number? It's never an absolute number given the underlying network and all that technology in between. But you want to have a kind of a reliability, a predictability in terms of those numbers, which makes it...
So it's becoming a more and more complex world where now you need artificial intelligence to actually help to make these things work properly. And everyone thinks that AI is something new, like Chat GPT. But AI has been around for a long, long time. Financial markets have been using AI, machine learning, pattern recognition for years and years and years. Like even the early 80s or even before. It's not just now. So Robert, how do you envisage AI being used in financial markets?
So just to answer Herbie's question about artificial intelligence and machine learning, we've been using that for years for maintaining orderly markets through market surveillance. But what's special today is about the scale of the size of models that we can handle. And that includes the large language models that are feeding things like ChatGPT, but also foundation models where you can actually feed in enormous sums and relationships in order to come up with new uses to provide operational efficiency, to try and make sure that when you're doing not just trade reporting to the market, but transaction reporting to the regulators with the enriched data fields, that you're getting the buys and sells correct and getting all that housekeeping, as well as insights to try and do more business on a cross-correlated manner. So it's really an opportunity for those to imagine what can be done. Technology will probably want to do, but then also we need to have a bit of governance around that. And this is where I think we're really lucky to have the regulators that we do, because we thank the regulators because they provide the framework within which we can behave as entrepreneurs. Thank you.
Yeah. So Stefan and Hamish, this is something you come across a lot. Are you using AI yet? Is it touching your part of the industry?
In fact, I've seen that customers of our customers have been using AI for quite some time to detect which gateway to use best, which one is the fastest, which way to go to and get the best trade from. So I'm also seeing this as some kind of experience and working. I wouldn't necessarily call it AI. This has been something where they have been using this technology.
I guess rules-based is
rule-based, exactly, and test-based. And I think this also stands and goes through for AI. It's only as good as the one who models the AI and the model. I think this is where still the human plays an important role.
Exactly.
And that, I think, can only be as good as AI, can only be as good as AI.
Indeed, and for AI to work, you have to have the knowledge to put into the system. Anyhow, I guess things like machine learning as well, pattern recognition, again, I guess that cloud computing is more prevalent, and that probably has more of an impact in your businesses. Hamish, is that something you guys come across?
Yeah, just to pick up on the AI point, I mean, I'm thinking one of the first projects I worked on was on an automatic of text extraction, price extraction from complex news stories. And with hindsight, maybe we should have branded that as being AI. There's a fair few systems that we've worked on over the years. We could probably have used that label. And we used to call it maths or statistics, surely. That's all it is. I mean, is AI going to replace your average trader, replace your average broker?
Well, let's face it.
Probably not. What it will do, I think this is the important point. It's a tool. An incredibly powerful tool, for sure. I mean, certainly some of what we've seen recently, but a tool nonetheless. And that's where it sort of has its place.
Absolutely.
And certainly a lot of roles will change, as they have already. And roles have changed over the last few decades with the electronification of the markets, as Robert was talking about at the start. And they'll continue to change, and AI will have a role in that. But it's change rather than wholesale replacement.
Now, Robert, there are lots of interesting things happen in terms of regulation. And one of the new things is something called DORA. Could you explain to us and indeed to the audience at large, what is DORA and why is it important?
Certainly. Thank you, Herbie. So DORA stands for the Digital Operational Resilience Act. That comes out of Europe. And while it is live today, the requirements become mandatory for financial firms on the 17th of January, 2025. Now, the focus is really around safeguarding resilience in finance versus cyber challenge because of the reliance on technology. And actually, as the audience has been listening to all of us speakers, you may get the insight that, wow, what we're able to do now in the financial markets is to trade more volume in more products faster, if we wish, but also with cloud computing, able to extend the hours of trading, the borders of trading, to ultimately maybe doing 24-hour trading the way FX is doing. DORA is an EU focus on specifically internet and communications technology, ICT, with 5 pillars to focus on risk management, incident reporting, testing, third-party risk, and information sharing. Now, in the UK, the FCA and the Prudential Regulatory Authority and the Bank of England rules have similar operational resilience, not specifically applying to ICT service providers, but it does focus on operational resilience more generally, where DORA is maybe more narrowly focused on digital operational resilience. Unlike DORA, the UK proposes firms assess impact tolerance for disruption to each important business service. Unlike DORA, UK proposes requirements for firms to map and test important business services to identify vulnerabilities. Unlike DORA, UK requires certain pre-approved control functions like chief operations functions, the senior management function 24 under the new regime to be responsible for managing these things. But ultimately, the UK regime is also coming in 2025, just like DORA, and firms complying with the EU's DORA can learn from the UK's regime and vice versa. Now, the one thing that is definitely consistent is the focus on the risk of third parties. And I want to really reference, in the public domain, there's an excellent speech by the CEO of the FCA, Nicola Ratti, given in July of this year, talking about the FCA's approach to regulating big tech and AI. And one of the key insights was the emphasis on third parties. And I just wanted to share a few insights from his speech. He said, as of 2020, nearly 2/3 of UK firms use the same few cloud service providers. And obviously, the regulator wants to regulate critical third parties. And relating to these critical third parties, that will include AI services, but ultimately it's to help ensure resilience, which ultimately comes down to confidence in the markets. Thank you.
Okay, Stefan, Hamish, your thoughts on DORA? Is it something which you're thinking of already? Is something, Hamish?
I mean, already, I think, as Robert said, I think the UK government's considering similar legislation, but already regulators are asking all our customers or all regulated entities a lot of questions, a lot of probing questions about their resilience, about how their systems operate, about what they would do in case of any failures. And quite rightly, some of those questions are filtering down to ourselves as a technology vendor, and we're having to, of course, work with our clients to help answer some of those questions, consistently work with them to improve processes. I mean, resilience is multifaceted at the end of the day. Clearly, when we're building software, that's almost paramount in all our minds. We have to look at that from the very beginning to be able to build systems that actually are resilient, especially given the industry, the nature of where they're deployed. So clearly, yeah, software resilience, network resilience are all incredibly important. I think there's one aspect that's often overlooked, and that's almost the human element, is human resilience as well. So that includes things like, well, do operational staff know what to do, for example, when there is failure? Do they know what the fallback procedures are? Are they able to actually handle those scenarios? And that's where, again, we as technology vendors do have that responsibility of engage at an early stage with our respective support teams, operational teams, have dress rehearsals, review procedures, review those processes to make sure that when failure does happen, we can mitigate the effects and get the market started again as soon as possible.
Before I turn to Stefan, those are all very interesting points. In fact, but this is nothing new, really, Dora. It's just bringing it all together in one place. But these are things that the market has always done, always wanted, in terms of resilience, in terms of standards, which make sure that the resilience is there.
And have always already provided. So I would argue this, as you say, is nothing new. And in fact, the product which we are owning and running and selling to the community is and was originally meant to be called resilient multicast messaging. So it was something which was built into the core concept to have something reliable as possible. And given that most of our customers are systematic relevant, so to have their operations run 24/7, that is something which is as critical as we see it. And this is in fact something which our customers are demanding for a long, long time. So I would argue that's nothing new. Yes, it's right. Dora brings some umbrella and some guidance to this, but in fact, systems in this area have been built with resiliency in mind, which is sometimes a trade-off to get the latency down, because it can either be resilient or reliable in the sense that you have multiple instances doing the same, but there's a trade-off in terms of latency with that. Also, with going into cloud, you definitely will face latency issues in favor of some resiliency and reliability.
There's always those trade-offs. It's interesting about any kind of software. There's always trade-offs between all these different factors. I mean, you can't have it all. And again, it's part of our role to explain to our customers what's feasible. Just wanted to pick up briefly on the cloud role and the role of cloud in going forward in the financial industry. I mean, I think for a while it took a little bit of time for people to start thinking, should we actually be using this? And the regulators had more focus on it as well. But clearly, there's a lot more adoption now. Certainly, in terms of using it, which I think is a great idea, using it for test environments.
Development
A really good way of going into it rather than immediately thinking, right, let's move all our production systems to the cloud. But I think one thing to note about cloud in general, it's a whole new skill set to actually manage these things, to actually keep them up and running. So while you might not necessarily be investing in physical infrastructure, there is a whole new skill set there that you need to do. And I think there's also the question of price structure as well. You're no longer investing you're not doing CapEx and investing in servers and routers and so on. You're now paying for compute time and compute and space, which is very different.
Going back to one of the points you mentioned about the human element in terms of resilience as well, and that often that's the weakest point actually. And that I know quite a few serious problems will happen when the human being waits too long before they ask for help. In other words, the standards say, when this happens, here's what you do. But someone wants to be brave and try and fix it themselves instead of shouting for help. And that's when you get absolute disasters. We've seen it happen quite a few places, even at exchanges. Anyway, one last question for the entire panel is that how do you define success when it comes to implementing technology in financial markets? Robert, turning to you first. How do you define success when technology is used to achieve something for you?
Thank you. So I say, firstly, understanding that in today's world, there can be a significant investment in technology to deliver kind of efficiencies on an enterprise-wide basis. And if the market design is done well, one can actually syndicate the cost across many participants so that people can really benefit from those efficiencies. So the three criteria for success: number one, can the business be done fully compliant and therefore avoid fines? That helps one's profitability. Number two, can one do business but do it in a more efficient, low-cost manner, that ultimately helps the profitability of the business. And number three, if one is able to do the business and do more of the revenue-generating business, that also helps profitability. So ultimately, success in working with a good technology partner should lead to overall enhanced efficiency and profitability. Thank you very much.
Okay, Stefan, how do you define success?
So in fact, our customers mainly define success in the attracting liquidity, and this is where and how market operate. So you could have the best trading infrastructure, if no one comes to play with it, then it's not profitable and it's nothing. So there, I think we would define our success, which is the success of our customers, meaning they attract market liquidity.
Okay, so easy way to measure success.
Yeah.
Absolutely.
Hamish.
Nicely following on from what Robert and Stefan were saying, I think the thing I'd add from a point of view of an individual software project is if it meets, I mean, clearly, yes, you want the business to succeed and increase profit and add more customers and so on and so forth. But ultimately, if it meets the vision, if the customer is happy that the thing they started out wanting to do with that new system has actually happened, then that's a success. And I think the other way to look at it is if no one says, oh, I wish you were still doing it the old way, still doing it old system, that's when you know you've got it right.
And obviously, repeat business.
Goes without saying.
Okay, now we have some questions from the audience, which we're going to run through. And if we don't have time to answer all the questions now live, we will be sending all the questions which we have answered to the panel, who will come back to you with answers. Now, by coincidence, the first couple of questions I can see are from people who I know very well. In fact, they're former colleagues of myself and Stefan. In fact, the very first question, Robert, you'll be pleased to know, is from one Paul Bowles, who you know quite well. Paul is at FTSE Russell in Canada. And the question from Paul is whether the panel feels that advances in artificial intelligence will enhance, disrupt, or make obsolete today's exchange technology. Robert, starting with you, what do you think?
Well, it was very interesting to hear that one of the lead speakers here at the Abu Dhabi Finance Week said, as a CEO, one should dedicate 30% of one's time to disruption. And that suggests to me that new uses of new tools like artificial intelligence will probably become an important feature of daily life. Thank you.
Stefan?
Yeah, I couldn't agree more. I think it's about being disruptive and trying to be successful in doing something new and different. And I think AI is a good means to try new technologies in being disruptive.
Hamish, got a view on this?
Likewise, absolutely. Disruption is almost certainly what it's going to do, as I was mentioning earlier. It's interesting that a couple of years ago, if we were having a similar conversation, it would have been about blockchain, and some of the more extreme views were that it will completely replace the need for clearinghouses, exchanges, and all of these institutions. But ultimately, we've been talking about trust quite a lot, actually. And fundamentally, whatever changes goes into technology, it's got to fit in with that fundamental market requirement, which is to create trust.
Blockchain, DLT, its time will come. I know that some of the early projects haven't quite worked out, like in Australia, for example, but it will happen. Now, the second question is from one Tony McCormack, who I guess some of us know quite well, again, ex-Reuters. What effect will DLT, crypto, and tokenization have on traditional exchanges and data vendors? Now, Robert, this is a question close to your heart, I know, because when we met up, I think it was in November, December last year, you were telling myself and or other guest partner that tokens were going to be the future of financial exchanges, tokenization. What's your view on this?
Certainly. Well, let's just define what we mean by the word tokenization. It's really nothing more than the way a depository receipt or an exchange traded fund actually work. It allows one to get access to an asset, but it also brings in the ability to fractionalize, to trade smaller components of the asset. It allows one to implement more efficient straight-through processing workflows to therefore save costs and improve workflow productivity. So I actually think a tokenization makes a lot of sense. A lot of the benefits will probably come from the post-trade workflow. It's interesting, and maybe Stefan can comment, it's always been interesting that people have observed how we've been able to increase the speed and lower the latency at the trading layer, even though the clearing and settlement can sometimes still be measured in days. But overall, I think tokenization in terms of helping reduce risk, but increase activity, and the direct link of ownership to the underlying will enable a whole load of new asset classes to come into the straight-through processing workflow that the institutions have already invested in. Thank you very much.
Robert, just to go back on that, will your new exchange, is it going to be based on tokenization, or is that not part of the deal?
No, absolutely. So if you take a look at what Ray Dalio, one of the great fund managers, has said, the ideal portfolio is a series of assets that are uncorrelated. That means when the market drops, all the assets don't drop at the same time. And often institutions will say one of the great uncorrelated assets is real estate, which has an addressable market of $300 trillion by many estimates and growing. And yet real estate is not well served by current electronic banking or stock exchanges because it's mostly analog, very manual, lots of paperwork. The opportunity to tokenize real estate, whether that's land or buildings, and actually to put it in the same straight-through workflow will bring much easier access to institutions. It also means things like funds that can be tokenized with real estate underlyings that, if you think about the gating issue where, let's say there's a commercial building within a fund and someone that has a unit says, oh, excuse me, can I redeem my unit because I need to pay some school fees? And the answer is, well, I'm afraid you're going to have to wait 6 months because the fund is gated. If you can actually tokenize that fund and trade the fraction, you can offer the ability to maybe that person accept a discount for the immediacy of cash. So you suddenly enable a lot more choice, not obligation, but choice to investors to help them get their business done. Thank you.
Hamish, are your clients involved in this already? Or?
There's so many analog, that's a great phrase, analog markets out there, even a lot of traditional OTC markets, where trading is still, literally there are still pieces of paper involved, or more practically perhaps, yes, there's still a spreadsheet somewhere, there might be something that might be written down, but fundamentally, yes, transactions are being done over the phone, by email. And I think we often talk about the concept of digitalization, and we're all using computers in one form or another. We have been since the 80s and certainly the late 1990s in the industry at large. But it's a difference between putting your trades in a spreadsheet and putting your trades in a system that actually logs them, audits them, monitors them, checks what their status is, and is able to feed them through to your post-trade system. And all those things, that's really what then takes trading to that next level. And there is the opportunity in many of these markets, using technology that firms like ourselves provide, to really bring the markets and open them to more investors and also benefit more people more widely.
I guess you don't care whether it's tokens or what. It's all it's data, and provided it's low latency, that's where you come in.
Exactly. But I'm with Robin and Hamish. So I think it's about opening the market for new asset classes, and especially as Rod said, the real estate is one area. I think art is another good example where you could tokenize,
but not NFT tokens. I hope.
No. But real art, so paintings and so on. So I think that's where you could create new marketplaces and exchanges for this kind of asset class.
Technology is a great enabler. Like everyone now thinks of the FX market as being on screen, but it wasn't always that way. The FX market used to be on the phone. Like if you saw a typical trader in those days, you have like 6, 8, 10 phones on all at once. All of those phones were replaced by a little silver screen about I think back in the 1972, 73. Okay? And that someone had the idea, why don't we electronify this market? That market is now one of the biggest trillions of dollars markets in the world, from the telephone on screen, and it never looked back. Now, Robert, the next question is from someone you know quite well, JP Mine, who I know you know very, very well. And JP's question is, which I think all of you have interested in, faster transactions, more volumes of data, more risks to be managed. Is the technology there to manage all this risk for more and more data? Stefan.
Risk, technology, I think, is only a tool, is only an enabler. You have to manage risk in various assets, facets, in different regulations. So that's something where technology can help you with, but cannot ultimately solve your issue.
Sonara does surveillance systems as well, or implements surveillance?
We built, again, pretty much any kind of system. If you think of the whole trade life cycle, there's obviously risk at every point and different. You can, it's interesting, if you create a diagram, you can identify the types of risk at almost every stage of that trade life cycle. And yes, technology, there is, to answer the question directly, yes, there is a lot out there. There's a lot that you can use as a starting point. But companies like ourselves, we use building blocks to help create custom solutions. So yes, we can help you with that, but ultimately that's part of the solution. And ultimately you need to decide, well, how does that fit in with your own processes? Are you actually using it in the right way? You can create a perfect system, but if you aren't actually using it correctly, or not even using the functionality in the best way, then ultimately all that investment isn't really being used in the best way possible.
Well, I know, Robert, things have changed a lot over the years. I remember when we first began to apply things like machine learning, artificial intelligence towards surveillance, that I remember going to the London Stock Exchange when the surveillance was being done by human beings, like most of them former policemen who said, we don't have any use for this technology, we know who all the bad guys are. Seriously. But Robert, going back to JP's question, is all that risk manageable as we have faster and faster transactions, more and more of it? Is it manageable?
Well, firstly, I think we need to recognize that, when we talk about trading modalities, one size doesn't fit all. And the ability to provide a choice of trading mechanisms that can be more useful in different economic microenvironments can help investors get their business done. But ultimately, to answer JP's question, which is a very good one, providing a level playing field, managing risk, and also communicating well in the event of a glitch to make sure that markets are managed in a smooth way to get them back up, it really requires a culture. And I think all of us were touching on the fact that technology are tools, very important tools, but you do need the human condition to be involved, to be aware, to have governance, to take accountability and responsibility of what's done, to understand the tools so they can be wielded in the most efficient way. Thank you very much.
Excellent. Now we have time just for one more question. And Paul Bowes is a glutton for punishment. And his question, again, is around blockchain technology. That will this technology disrupt or replace traditional exchanges? I mean, again, we've seen a few experiments in terms of surveillance, but we haven't seen any blockchain-based exchanges, have we, Robert? Or am I wrong in that aspect? Do you know of any exchanges working off block? I guess it will happen. If it hasn't happened already, it will happen.
Well, I think what's special about blockchain, if you listen to the definition of it, it is a database that is immutable, that is often in a distributed basis. Now, you can have a distributed database that's still permissioned or made public. I feel that, in my humble opinion, many of today's existing institutions like a permissioned model, because then they know where to go, who to speak to when something goes wrong. But in my humble view, where the distributed ledger technology will really provide some differentiation is the fact that you can have activity cross-border and have one version of truth while recognizing that many national competent authorities are very country-specific in their locus, and they may often want a technology box within their own country's borders. But you can still have a global market, as we've learned from smart order routing technology and other low latency systems that our colleagues Stefan and Hamish can talk to, where you can have multiple physical puddles, but one virtual pool of liquidity. I think the distributed ledger will do for the post-trade world in particular settlement, one version of the truth, no matter where anything is trading, where that every one of those national competent authorities or anyone that's looking into the blockchain or the distributed ledger can actually see that single version of truth. And that should add for further confidence on the global market stage. Thank you.
Thanks, Robert. Stefan?
Yeah, I couldn't agree more. I think when it comes to local and national technologies. I don't see blockchain in that sense and that importance when it comes to the cross-border exchange, and their blockchain could play an important role.
Hamish, any views on this?
In blockchain, from a fundamentals of engineering software point of view, it's an amazing technology. It solves certain problems. Ultimately, it's about how it's implemented, whether it actually provides a genuine advantage over more traditional types of databases. But again, from the business angle, as Robin and Stefan have been discussing, is finding a model where that actually provides a real differentiation from what exchanges do at present.
Well, ladies and gentlemen, that's all the time we have today. So I'd like to thank our panelists, Robert Barnes in UAE, Stefan here in London, and Hamish also in London. There will be a recording of the webinar, which will be made available in the next few days. But thanks to everyone. Thanks to our audience, and thanks to our panelists. Thanks for your time. Thanks, everyone.
Thank you.
Thank you.
Thanks very much.